Assalamualaikum. I beg to my respected lecturer, Madam MASNIZA, and my fellow friend. Today, our group will present about capital acquisition and repayment cycle. First and foremost, let me introduce my group members starting with me. I am Safiah Fatin Nadhira. Next, Ain Munirah, Izzani Nasuha, Nurul Aina Izzati, Nik Anis Ilyana, Ain Natasha, and Nur Rafhanah. Capital acquisition means that it is a capital account. For example, when we want to do a business expansion, so we need more capital. The capital is sourced through issuance of loan and share capital. Next, for the repayment cycle, is referring to the repayment of interest on loan and payment of dividend to the shareholder. Repayment of interest on loan needed to be paid by monthly basis, and for the payment of dividend, paid by annually depending on the performance of the company. Next, I will explain about 4 characteristics of the capital acquisition and repayment cycle. Firstly, relatively few transactions affect the account balance, but its transaction is often highly material, means that capital acquisition have a few transactions in the company, but each transaction have a large amount. For instance, we wish to expand our business. We will require additional capital and will seek a loan around 150,000 from a bank. This loan will not be applied every year, as we will use it only when we are having financial difficulties or want to add additional capital. In audit engagement, it is not necessary that we will find a new loan when we audit. So if there is no loan, means there is no additional long-term liability to the company, but you will audit the existing loan. Secondly, the exclusion means omission or unrecorded or misstatement of a single transaction can be material. If there is unrecorded loan or liability, so the effect misstatement of single material can be material in the financial statement because no recorded one single liability. When you exclude a new loan from the SOFP or financial statement, the effect is highly material. Thirdly, is a legal relationship exists between the client entity and the holder of the share, bond, or similar ownership document. When a company issue a share, automatically they have created a legal relationship between the shareholder and the client. Lastly, a direct relationship exists between the interest and dividend account and debt equity. When the audit of interest-bearing debt account, auditors should verify the related interest expenses and interest payable. This is applied for owner equity, dividend declared, and dividend payable. For the next slide, I will continue to the account that involved in the capital acquisition and repayment cycle that depends on the type of business the company operates and how its operations are financed. The first one is not payable or loan payable. Not payable is the amount of principal due on a former written promise to pay, or this account also include loan from bank. For example, agreement between bank and client. The client has agreed to pay to the bank amount that he borrowed within a specific time. Second, for the contract payable, it means if you have a large project going on, do not rely on the payable report alone and make a list of all contractors on the project. It also need to check written to each vendor because the payment are large. So if you miss one, it could result in a material audit adjustment. Next is for the mortgage payable or loan if we buy a property. It is a liability account whose balance is the unpaid principal balance as of the balance sheet date. A current liability is the amount of principal that required to be paid within 12 months of the balance sheet date. For the bond payable are the form of long-term debt and usually issued by the corporation, hospital, or government. The issue of bond make a formal agreement to pay interest, usually every 6 months, and to pay to the principal or maturity amount at a specific date in the future. Example, public utilities will issue bond to help finance a new electronic power plant, hospital issue bond for new building, government issue bond to finance project to cover deficit or to pay the older debt that is now maturing. For the interest expenses, it is a non-operating business shown on the income statement and represent interest payable on any type of borrowing such as bond, loan, convertible debt, or line of credit. It is basically calculated as the interest rate times the outstanding principal amount of the debt. For the accrued interest, it is the amount of interest that has been accumulated on a debt since the last interest payment date. Accrued interest can be two sides, which are accrued interest expenses owned by the borrower or accrued interest income on customer deposit that owned by the bank. Next is appropriate retained earning. Appropriate retained earning are any unappropriate retained earning that are specifically not to be used for dividend payment, and retained earning that are specified by the board of directors for a specific use. Appropriate retained earning can be used for many specific purposes such as debt reduction and acquisition. For the treasury share, that it represents the portion of share that a company keep in their own treasury. Treasury share may have come from a repurchase or buyback from the shareholder, or it may have never been issued to the public in the first place. These shares do not pay dividend, do not have to be included in the calculation of outstanding share, and have no voting right. All cases that related owner equity or any changes during the period should be indicated in the statement of stockholder equity. For the dividend declared, it is annually and paid to the shareholder when the company performance is good. When it is suffer losses, we will unable to pay dividend to the shareholder. Next is cash in the bank. It means the sum of all coin, currency, and cash items have been placed on deposit with a financial institution. For ordinary share, an ordinary share is an equity instrument subordinate to all other equity classes. The holder of an ordinary share participated in an entity profit only after all other types of share have been participate. The owner of the ordinary share can be voted on a variety of corporate matters such as election of board member and whether the business should be sold. Lastly, preference share. Preference share consists of a company share with a dividend that are paid to the shareholder before ordinary share dividend are paid out. There are four types of preference share, which are cumulative, non-cumulative, participating, and convertible. Preference shares are ideal for risk-averse investor, and the issuer can redeem them at any time. Next, I will pass to the next presenter.
Hi, I am Ain Munirah and I will present the other account that includes in the audit of the capital acquisition and repayment cycle. We move to the other account, which is donated capital. Donated capital is assets given to a company as a gift. Usually, this asset is given by the other company or states and local government to induce a business to relocate to their jurisdiction. This amount is recorded at its fair value as of the date when the gift was received and presented as part of the shareholders' equity. For example, a manufacturing facility received a parcel of land as a gift from a local community when the business agrees to construct a facility there. For retained earning, it is the profit that a company has earned to date, less any dividend or other distribution paid to its investor. Retained earning is the corporation's past earning that have not been distributed as dividend to its shareholder. Understanding our company's retained earning is important because it enables us to understand how much money is available for activity like expansion or asset acquisition. If the company has retained positive earning, that means it has a surplus of income and can be used to reinvest in itself. Negative profit means that the company has amassed a deficit and owes money more in debt than the business has earned. We also have dividend payable. Dividend payable is the dividend that a company's board of directors has declared to be payable to its shareholder. So, it is exists after the company already declared the dividend but has yet to pay. Same as dividend declared, the cash amount of the dividend is recorded as a current liability in an accrued dividend payable account until the company actually pays the shareholder. Other than that, we also have capital account, which is proprietorship. This type of business entity is owned and run by one natural person and in which there is no legal distinction between the owner and the business. It is the simplest business form as one can operate a business and not a legal entity. However, the person who owns this type of business is personally responsible for its debt because it is an unlimited liability company. The liability is not capped and the obligation can be paid through the seizure and sale of owner's personal asset. Lastly, partnership. In partnership, each partner has a separate capital account for investment as well as a separate withdrawal account for his or her share of net income or loss. In a general partnership, all parties share legal and financial liability equally. The individuals are personally responsible for the debt the partnership takes on. Profit are also shared equally. The specific of profit sharing will almost certainly be laid out in writing in a partnership agreement. The amount of money or other property that all the partners have contributed with the agreement of the other to the permanent endowment of the firm. We move to the next slide, which is methodology for designing tests of balance for payroll liability. In this methodology, we have three phases. The first thing we have to do in phase 1 is identify client business risk affecting notes payable. Business risk is an exposure of a company towards risk that can cause lower in profit or failure in business. It is important for the company to identify the business risk because it can affect the notes payable. Let's say the client is unable to get profit or having a poor cash flow. It will affect the company to pay installment to the bank. The next step is in phase 1 is to set tolerable misstatement and assess inherent risk for notes payable. Usually, the tolerable misstatement in the cycle is lower. And one particular factor that can increase inherent risk is the presence of related party transaction. The most important balance-related assertion in notes payable are completeness. An auditor focusing more on this since not payable is a liability and misstatement could be material if even one note is omitted or incorrect. There is more chances for client to understate the liability. Last step is assess control risk for notes payable. Control risk is the auditor assessment that is likelihood that misstatement is exceeding the tolerable amount and will not be prevented or detected by the client's internal control. Note payable is highly material and need high level of approval from board of director or management. In phase 2, we have design and perform test of control and substantive test of transaction for capital acquisition and repayment cycle. In certain instances, additional tests of control may be performed as part of test of detailed balance due to the materiality of individual transaction. Test of control for net notes payable and related interest should emphasize testing the four important internal control. The result of substantive tests of transaction normally less important because the cycle only contains a few transactions. In the last phase, we have to design and perform analytical procedure for notes payable balance and design tests of details of note payable balance to satisfy balance related audit objective. Analytical procedure are essential for notes payable because tests of detail for interest expenses and accrued interest can frequently be eliminated when results are favorable. Test of detail of notes payable will be designed in respect with audit procedure. In this cycle, there is no sample size because we use 100% audit since we only have few transactions. So, no sampling on loan is made. The more audit procedure we perform, the more items we need to select. And for timing should be as much as possible closer to the ending of the accounting period so that we will able to achieve ending balance at the end of accounting period. Next, I will pass to the next presenter.
Assalamualaikum warahmatullahi wabarakatuh. My name is Nur Izzani Nasuha Binti Zulkifli, and today I will present about notes payable, objective of the audit of notes payables, and also internal control. Okay, first, there are two types of notes payable. Firstly is secured or unsecured by asset. For secured, the lender, which is bank, will ask each asset. So there is a collateral between the lender and the borrower. For unsecured, whereby there's no pledging of assets, so meaning that there is no collateral between the lender and the borrower. To determine whether the loan or notes payable is secured or unsecured, it depends on the client's financial stability. For example, the lender will check on the client's audited financial statement first. They want to look specifically at the client's financial position. If the company or the clients have a strong financial position, usually the bank will offer unsecured loan, so no need any collateral. But if the client or company have average financial position, the lender or bank might request a pledging of asset. Okay, next one is legal obligation. Legal obligation is involved between the lender and the client. If there's any breach of agreement, the bank has right to sue the borrower. Okay, so next slide. Securities, account receivable, fixed asset are the example of asset that might be pledged against loan. It's either security. Security is an investment. Account receivable and inventory are current asset. Fixed asset is property, plant and equipment. Notes payable, it can be fall under current liabilities or long-term liabilities depending on the duration of the loan. Principal and interest depend on term of loan agreement. Okay, next slide. For objective of the audit of note payables is to determine whether the contract activities are strong over notes payable, which is include authorization or approval of transaction and the accuracy of recording liabilities and expenses. Okay, so next slide. For internal control, First point is proper authorization for the issue of new notes. Board of directors or high-level management are the one who is responsible over issuance of new notes. Two signatures of properly authorized officials are required for all loan agreements. When notes are renewed, they need to be subject to the same authorization procedures as those for the issuance of new notes. For second point, adequate control over the repayment of principal and interest. Periodic payment of interest and principal should be subject to the controls in acquisition and payment cycle. At the time the note was issued, accounting department should have received a copy of the note, much like it received vendors' invoices and receiving reports. Account payable department should automatically issue check or electronic fund transfer for the note when they become due. A copy of the note provides the supporting documentation for payment. Okay, so the third point is proper document and records. This includes subsidiary records and control over blank and paid notes by an authorized person. Paid notes should be cancelled and retained under the custody of an authorized official. The last point is periodic independent verification. Periodically, the detailed note records should be reconciled with the general ledger and compared with the note holder's records by an employee who is not responsible for maintaining the detailed record. At the same time, an independent person should recompute the interest expense on notes to test the accuracy of the record keeping. So that's all from me. I will pass to the next presenter.
Thank you to Izzani and Nasuha. Next, my name is Nurul Aina Izzati. So we continue the presentation with the journal entries of the notes payable and the related interest account. And in the textbook, you can turn to page 680, table 22.1. This is the journal entries of the notes payable, interest expenses, and interest payable. For the interest expenses, we also call accrued interest, which is the account is due, but the client does not pay the expenses. Next, for the test of control and substantive test of transactions is to test of notes payable transaction that involve accurate recording of receipts from the notes process and the repayment of principal and interest. Audit test, also known as audit procedure, is a part of the test of control and substantive test of the transaction for cash receipt and cash disbursement. Usually, the issue is on the accuracy because the amount of the principal and interest is fixed. That's why there is a less issue on the accuracy part. Unless the staff itself who are record and prepare cash disbursement do not carefully take in or record of the cash disbursement. But when there is independent verification happen here, there will be less issue on the accuracy and this error of the take-in of cash disbursement will not happen. Next, for the part of analytical procedure for notes payable, firstly is we calculate the interest expenses, interest payable on the average interest rates and overall monthly notes payable to see that whether there is a misstatement of the interest expenses and interest and accrued interest or omission of the notes payable on the understatement of the recording. And this issue is easier to detect because amount of principal is fixed. For example, when you pay an installment, the amount you pay every year supposedly to be fixed when you compare the amount this year with the previous year. But when the amount you pay is lower than previous year expenses, you need to check why the amount is lower. Maybe this issue happen when there are cancel notes or unrecorded installment. And next, compare individual notes outstanding with those of the prior year to see whether they have omission or misstatement of the notes payable, and then compare total balance is not in notes payable means that how much your remaining loans, total interest expenses for the year, and accrued interest if any with prior year balance. The purpose why we do these things is to see whether there is a misstatement of the interest expenses and accrued interest of notes payable. That's all for me. Next, I will pass to the next presenter.
Thank you to Aina. Hi, I am Nik Anis Ilyana. I will be present about major balance related audit objective in notes payable. There are two most important balance related audit objective in notes payable, which is completeness, that existing notes payable are included, and accuracy for notes payable in the schedule are accurately recorded. The applicable of balance related audit objective and common audit procedure they apply to the schedule of notes payable. The amount of testing depends heavily on the materiality of notes payable and the effectiveness of internal control. These objectives are vital because a misstatement can be material if even one note is omitted or incorrect. For example, audit objective for completeness, when internal controls over notes payable are deficient, auditors may need to perform a standard procedure to test for omitted notes payable. Next, I will be passed to the next presenter, Ain Natasha.
My name is Nur Ain Natasha Binti Pauzi. So next, I will proceed to the last subtopic of this chapter, which is honest equity. There is an important in the audit of honest equity between publicly held corporation and closely held corporation. For publicly held corporation, the verification of honest equity is more complex because they have many shareholders and frequent changes in the individual holding the share. For the closely held corporation, they have a simple and few transactions, few shareholders, and occasional transactions that occur during the year for capital share account. Closely held corporation rarely pay dividends and the auditors spend little more to verifying honest equity even though they must test the corporate record. The rest of this chapter deal with tests for verifying the measure of honest equity accounts in a publicly held corporation that include capital and ordinary share, retained earning and related dividend. Right? Okay, next. There are three primary objectives in the audit of honest equity. The first one is to determine whether internal control over capital share and related dividend are adequate. Second, to determine whether honest equity transactions are correctly recorded as defined by the sixth transaction related audit objective. And the third one is to determine whether the honest equity balance are properly recorded as defined by the eighth balance related audit objective and properly presented and disclosed as defined by the fourth presentation and disclosure related audit objective for honest equities account. Okay. Next slide. This is the example of honest equity and dividend account. Next slide is the important internal control for honest equity. The first one is proper authorization of a transaction. Honest equity transaction is typically material, so it must be approved by the board directors. There are several types of honest equity transaction that require specific authorization, which is issuance of capital share, repurchase of capital share, and declaration of dividend. For the issuance of capital share, the authorization includes the type of equity to issue, such as preference or ordinary share, number of shares to issue, privilege condition for any share other than ordinary, and date of the issue. For the repurchase of capital share, the repurchase of ordinary or preference share, the timing of the repurchase, and the amount to pay for the share should all be approved by the Board of Directors. And for the declaration of dividend, the Board of Directors must authorize the form of the dividend, such as cash or share, and the amount of the dividend per share, and the record and payment dates of the dividend. Okay, second, proper record keeping and segregation of duties. When the company maintains its record of share transaction and outstanding share, the internal control must be educated to ensure that the actual owners are recognized in the record. The record amount of dividend is paid to the shareholder and the potential for misappropriation of asset is minimized. As a control over capital share, most of the company maintain stock certificate book and shareholders capital share master file. A capital share certificate record records the issuance and repurchase of capital stock for the life of the corporation, while a shareholder's capital share master file is the record of outstanding share at any time given. That's all from me. I will pass to the next presenter.
Hi, I am Rafhanah Binti Megat Muhammad Rodzi. Next, I will continue presenting the subtopic of honest equity, which is its importance of internal control. The third one is independent registrar and shares transfer agent. Any company with shares listed on a securities exchange is required to engage an independent registrar as a control to prevent the improper issue of share certificates. An independent registrar is appointed to ensure that share is issued by a corporation in accordance with the capital share provisions in the corporate charter and the authorization of the board of directors. When there is a change in the ownership of the share, the registrar is responsible for signing all newly issued share certificates and making sure that all certificates are received and cancelled before a replacement certificate is issued. Many companies employ the service of a shares transfer agent to maintain the shareholder records, including those documenting transfers of shares ownership. The employment of a transfer agent helps strengthen control over the share records by putting the records in the hands of an independent organization and helps reduce the cost of record keeping by using a specialist. They also have the transfer agent disburse cash dividends to shareholders for further improving internal control. Then I will proceed with audit of capital shares and pay-in capital. Auditors have four main concerns in auditing the shares. First is completeness, where existing capital share transactions are recorded. This objective is easily satisfied when a registrar or transfer agent is used. The auditor can confirm with them whether any capital share transactions occurred and the accuracy of existing transactions, and then determine if all of those transactions have been recorded. Second is occurrence and accuracy, where recorded capital share transactions exist and are accurately recorded. Extensive auditing is required for transactions involving issuance of capital share, such as issuance of new capital share for cash, the merger with another company through an exchange of share, donated shares, and the purchase of treasury shares. The third one is accuracy, as capital share is accurately recorded. Auditors verify the ending balance in the capital share account by first determining the number of shares outstanding at the balance sheet date. A confirmation from the transfer agent is the simplest way to obtain this information. When no transfer agent exists, the auditor must rely on examining the share records and accounting for all shares outstanding in share certificate records, examining all cancelled certificates, and accounting for blank certificates. And lastly, presentation and disclosure, where capital share is properly presented and disclosed. The auditor should determine that each class of share has a proper description, including the number of shares issued and outstanding, and any special rights of an individual class. Auditors should also verify the proper presentation and disclosure of share options, share warrants, and convertible securities by examining legal documents or other evidence of the provisions of these agreements. First two concerns involve test of controls and substantive test of transactions, while the last two involve test of detail of balance and related disclosures. Now let's move to the audit of dividends. There are 6 transaction-related audit objectives for audit of dividends, including those concerning dividends payable, which are occurrence, completeness, and accuracy. The emphasis in the audit of dividends is on dividend transactions rather than on the ending balance, and there is exception when there are dividends payable. All 6 transaction-related audit objectives for transactions are relevant for dividends, but typically dividends are audited on a 100% basis. Auditors can verify the occurrence of recorded dividends by examining the minutes of Board of Directors meetings for authorization of the amount of dividend per share and the dividend date. While doing so, the auditor should be alert to the possibility of unrecorded dividends declared, particularly shortly before the balance sheet date. A closely related audit procedure is to review the audit permanent file to determine whether restrictions exist on the payment of dividends in bond indenture agreements or preference share provisions. The accuracy of a dividend declaration can be audited by recalculating the amount on the basis of the dividend per share times the number of shares outstanding. If the client uses a transfer agent to disburse dividends, the total can be traced to a cash disbursement entry to the agent and also confirmed. When a client keeps its own dividend records and pays the dividends itself, the auditor can verify the total amount of the dividends by recalculation and reference to cash disbursed. In addition, auditors must verify whether the payment was made to the shareholders who own the share as of the dividend record date. In addition, auditors must verify whether the payment was made to the shareholders who own the share as of the dividend record date. They can test this by selecting a sample of recorded dividend payments and tracing the payee's name on the cancelled check to the dividend records. At the same time, auditors can verify the amount and the authenticity of the dividend check. Test of dividends payable should be done in conjunction with declared dividends, and any unpaid dividend should be included as a liability. That's all from me. I will pass to the next presenter.
Thank you, Rafhanah. Now we will go to the last subtopic of this chapter, which is audit of retained earnings. For most companies, the only transaction involving retained earnings are net earnings for the year and dividends declared. Other changes in retained earnings may include correction or of prior period earnings, prior period adjustment charge or credited directly to retained earnings, and the setting up or elimination of appropriation of retained earnings. To begin the audit of retained earnings, first auditor must analyze retained earnings for the entire year. A description of every transaction affecting the account is included in the audit schedule, presenting the analysis, which is normally a part of the permanent file. Auditors simply trace the entry in retained earnings to the net earnings number on the income statement to complete the audit of the credit to retained earnings for net income for the year or the debit for a loss. Of course, when all correcting entries impacting net earnings have been completed, this operation must take place fairly late in the audit. Auditors must assess whether transactions should have been included in retained earnings other than net earnings and dividends. When auditing debits and credits to retained earnings, prior period adjustment, for example, can only be included in retained earnings if they meet the requirement of accounting standards. After the auditor is satisfied that the recorded transaction were correctly classified as retained earnings transaction, the next step is to decide whether they were accurately recorded. The evidence needed to determine accuracy depends on the nature of the transaction. For example, If an appropriation of retained earnings is required for a bond sinking fund, auditors can determine the correct amount of the appropriation by examining the bond indenture agreement. Auditors must also evaluate whether any transaction should have been included but were not. For example, if the client declare a stock dividend, the market value of the security issue should be capitalized by a debit to retained earnings and a credit to capital stock. Similarly, if the financial statement include appropriation of retained earnings, the auditor should evaluate if the appropriation is still required as of the balance sheet date. Accounting standard require presentation and disclosure of information related to retained earnings. The auditor primary concern in determine whether presentation and disclosure objective for retained earnings are satisfied primarily relates to disclosure of any restriction to on the payment of dividends. Often, agreements with bankers, stockholders, and other creditors prohibit or limit the amount of dividends the client can pay. This restriction must be closed in the footnotes to the financial statement. That's all from us. Thank you.